Today we're back with Matt Williams, owner and founder of JTM Capital Management. And we recently got a question from someone who submitted, do you practice what you preach in your business? Do you do the same things for yourself financially as you would for your clients? So I wanted you to talk a little bit about that and let us know what you do personally.
Anytime I'm speaking with clients and I, would typically tell them like, just complete full transparency, I'll say, well, this is what I do. I'm telling you this is what I do also. I mean, I could probably start from the beginning and
Sure.
maybe kind of kind of self scout, to use the term, as far as like what I've done for myself. So I'm 41, I'm married, I've got almost a, 6-year-old. My wife and I have been married since 2018. So obviously there's, been some evolution of what I've had to do for myself and my family. But what I would say is, like, starting off maybe from, laying the foundation of being a business owner and then getting married would be, the way my wife and I effectively coexist. And I've told people this is what I think, at least what makes us work, from a personal financial standpoint, is, we got married, we, decided, as far as like bank accounts, each of us have, individual bank accounts that we do. Now, obviously I own a business, so I have to have some things segregated from that standpoint, but we also have a joint account, that we pay all household expenses out of that. We've got separate credit cards, but everything that's a household expense goes from there. That's how at least we coexist.
Is there
Um,
any place where you would recommend that people keep separate accounts or a single account jointly, or does that not really matter?
well, I mean, just the reason I don't think you want to get things commingled, especially, let's say, if you own a small business like, myself, is that I have to kind of keep track of, everything from a tax standpoint,
Right.
in personal accounts. And then obviously if I'm like, paying contractors or anything. And then as far as like, for my wife, same thing. I mean, she gets, her paycheck paid to individual account. And then what we end up doing is just we end up having things that end up getting transferred automatically monthly to the joint account. All of our household expenses are paid for out of that. Mortgage, any utilities. I mean, pretty much anything that we've got on a monthly basis that I would consider household expense is paid out of there. Let's say, we, got married, we bought a house. As far as, buying a home, that's always a really really interesting, experience, for a couple. We purchased a house, we got a mortgage, we put, just slightly more than 20% down, which is what I always would recommend for, people to avoid, the mortgage insurance. What we do there is, and I've mentioned this and I've advised some clients to do this, is that uh, we've got a 30-year fixed, that we took out in 2019 when we bought our home. We do extra monthly principal only payments where, when I calculated our mortgage, what I wanted to do was have it to where we pay it off roughly around the time our son graduates from high school. So we did that for, for two reasons. One, just to pay it off. Oh, excuse me, several reasons. Pay it off early. You reduce the total amount of interest that we're paying on the note over the life of the mortgage. And then also, just so when he graduates from high school, whatever college looks like here in more than a decade, that cash, monthly cash flow that's been going towards the mortgage, we have freed up for, whatever type of expenses we'll have when he's in college, or again, whatever things end up looking like here. I do mention to clients sometimes when I'm giving points, that you have to remember, me owning a business, sometimes there's things that are quasi personal, quasi business. So there's sometimes maybe some of the metrics that I, advise people might not be exact. So say, like, for me, like, I normally recommend someone have somewhere between 6 to 9 months of uh cash reserves, as far as like an emergency fund, and that's normally 6 to 9 months of fixed expenses. I do that for both personal and business. So I probably end up keeping a little bit more in reserve in a, cash in a money market fund that's a little bit more than, let's say, 6 months of just my personal expenses. It's both. So that's, that way I've got enough of a reserve to meet anything if there's ever just an emergency or there's some disruption in business or something along those lines.
And
So
you mentioned a money market account. Is that the type of account specifically that you would recommend people keep that extra cash in?
anything that's earning a reasonable rate of interest. I know that the
Right.
problem right now for most checking and savings accounts at banks is that they're paying well below what I would consider the market rate of interest, which is just what you could get on a T-bill or a money market fund. So, I mean, I keep it kind of segmented where I've got a couple months cash just in a checking account, for business
Right.
because things are constantly going out, and then anything that I maybe don't need for like 3 months, that's in a money market account or a savings account. Just, something that's paying a reasonable rate of interest that's liquid. Then after that, because I'm self-employed, I've got a SEP IRA. I do my best every year to try to max that out. So what that ends up being is it's about 20% of my net schedule C. So I try to teach people that if they can, try to save somewhere around 20% of your earnings each year. That if you can do that, I mean, at least 10, but if you can get 20 or somewhere north of 20, those habits are going to end up, compounding over the long run, and you'll be able to retire or at least have the ability to retire much sooner.
And you had mentioned in one of our previous conversations that as soon as you graduated college, you were putting half of your paycheck away.
First off, I'll say, like, I wasn't really lucky enough. When I started off, from the first maybe decade of my career, uh, I worked at places that maybe were a little bit more risk taking from the standpoint of, working for some, I would almost maybe say like a startup or places where we didn't have a retirement account. So like what I had to do was I just looked at it and said, okay, well, I'm going to try to save a third to half of what I make every single month so I can build up savings, put that in the market. And at the time, we were coming right off the financial crisis. And I just thought that after that, it was just, there were so many things that I wanted to buy coming off of that,
Right.
I thought it was just a fantastic opportunity, and it ended up being that there in 2000, 9, 10, etc. But, the moment that I, started, doing this here about 10 years ago, I immediately opened up a SEP IRA, and did my best each year to try to max it out as best I could. And then I still do that. Now, one thing, that I'll mention here that I'm contemplating because of some rule changes that have come out recently. I am also contemplating opening up a solo 401k for myself. I have some clients that have solo 401ks, and what those are is that's just another vehicle, tax advantage vehicle for retirement for people that are self-employed. And what I can do there is that they are now allowing Roth contributions in solo 401ks. So,
Okay.
so me having a SEP, I'm limited to just the employer contribution for my retirement plan, which is again limited to 25% of earnings. But for me, because I'm the employer, it's about 20% of my net schedule C. You're limited there to $70,000. Now, the employee share, which is what everybody does with their 401ks, which is if you're under 50, it's the 23.5. You can open up the solo, and I can put in 23.5 as the employee in a Roth, and then I can also still max out the employer contribution of my SEP pre-tax. Now,
Okay.
they allow you with the solos to actually do both the employee and employer Roth contribution. Now, the issue there, the caveat I'm going to give is I custody at Fidelity. Most of the brokerage firms have not figured out yet how to allow you to make either SEP contributions or the employer contributions and solos with the Roth. So all they're allowing right now is just Roth contributions with the employee share. So, so for the first time ever, outside of, let me say, like a few years where I was making Roth IRA contributions, like this is the first time in a long time that I can make Roth contributions, myself. So
Right.
that's something else. So again, if you're a small business owner and, let's say the only thing you have is a SEP IRA, or let's say you've got a solo and you've just been making pre-tax contributions, that is a change. And that I think is a benefit where you can make the before tax contributions still for your employer share in the SEP, and you've got the option now to make Roth contributions with the employer share if you have to open up a solo. So you can have both. You can have a solo 401k and a SEP IRA as a business owner.
Okay.
So
That's great. So how have things changed kind of as you spoke a bit about what you did when you first started the workforce, then as you got married, and how about having a child? How has that come into play with your finances?
the first thing we did when my son was born was we opened up a 529 here in, the state we're residents. And, we do our best each year to, to effectively try to max that out. So the most you can do in the state of Virginia, as far as getting a Virginia state tax deduction, is $4,000. Now, we have started doing more than that each year, specifically because since they changed the rule, where if there's any unused balances in 529s, after the child's done doing, college, or there's a lot of different things you can utilize 529s now for. You can transfer any of the unused balance into a Roth IRA for them.
That's
Now,
great.
oh yeah, so from that standpoint, instead of, let's say, us looking at opening up a UGMA, which is a type of a custodial account where, it's just a taxable account where, like, myself or my wife would open it up and then my son would inherit it, when he's 21. We're utilizing the 529 now because, once, that's used up, or he's done, and there's a hopefully a large unused balance, he can roll that money into his own Roth and have that, for him, to get him started on his own retirement. So now, bear in mind, there's a couple uh caveats you gotta keep to. You can't, let's just say, if you've got $50,000, you just can't roll the whole 50,000 in one swoop.
Right.
You're limited to, the account has to be open for 15 years. The funds have had to have been in there for at least 5. You can roll over each year the max, which is right now $7,000, and you can do that up to a max of 35. Now, I imagine they'll increase some of that as time goes on, just because of the impacts of inflation. But right now, those are some of the specifics as far as rolling over the unused balance in a 529 to a Roth.
Well, we talked a lot about savings. How about spending? Tell me a little bit about your spending habits. What do you allow yourself, or, like some of the fun stuff?
I'm frugal. Most of my spending in a lot of cases is business related.
Of
If I
course.
have something that's a vice of mine, it's probably anything health related, which I would say, kind of going from that, what I would probably segue into is estate planning, like what I do for myself. But like my spending is, I'll say, like, I try to pay my credit card off every month. I try to utilize my write-offs with my business as much as I can. I try not to do anything I would consider, reckless spending. I'm just kind of frugal by nature.
Right.
It's just how I am. Because again, like, I try to save as much as I possibly can, so that, I've got the ability, even if, let's say, when I'm working for another 30 years, maybe here in 10, 15 years, I've got the ability to, if I wanted to, retire, I can, but that's not necessarily what I'm looking to do. But I'd say, segueing into the health related things, one thing I've found is, I've got a lot of clients that, and I've always told them, like, I don't liken myself to be an insurance salesman, but
Right.
what I have noticed is, just, being a certified financial planner and looking at the whole picture for people, is I find there's just a lot of men, specifically, or let's say young parents, that are just woefully underinsured. They have kids, they've got a mortgage, and then they come to me, and I said, well, you've got all these liabilities, you don't even have life insurance. And what that
Right.
ends up leading into is the discussion on going and getting a physical, getting labs done, knowing, what your blood markers are. Because I'll say, like, I joke with people, one of my jobs isn't just to give sound financial advice. It's like, I would like to keep people in reasonably good health so they can continue being clients.
Well, health is wealth, as they say.
Yes,
So,
absolutely. And often overlooked part of the whole, financial planning or advising process is the, longevity planning and protection. So I'll maybe, stepping back and looking more at just, the numbers, like for myself. Um, I've got my own term policy. Now
right.
that's evolved, and as time has gone on, I've gotten a second one and added to it. So right now, I'd say there's different ways that I value this, like, as far as the amount of life insurance one should have. I've got about 10 times my net earnings right now in 2 different life insurance policies. So I took the first out in 2019 before we purchased our home and before my son was born. And then here last fall, when I realized that just based on growth of my business and circumstances changing, I said, okay, well, I'm actually underinsured. So
Right.
I went and took out a second one, to get me up to where I felt I was adequately insured. So like I don't recommend for everyone to have 10 times their, income. Mine just happened to be around that because again, I've got some circumstances being a business owner where it's virtually all personal, but I had to take into account some issues business related that I didn't want my wife or son dealing with things if, God forbid something happens to me. So,
Makes sense.
yep.
Okay, well, any final thoughts or anything else you'd like to share on this topic?
I always will just say that I'm a big proponent in just having skin in the game and practicing what I preach. And, I again always kind of use myself as a guinea pig, with clients, before I end up recommending doing something, I do it to my I kind of do it to myself and then go from there. Now again, I'm not, I don't, not every circumstances I have is going to be one that another client has, but for the biggest things like my savings, my investments are tied right along with my clients where I'm not doing anything for myself that I'm not, excuse me, doing for clients, vice versa. Uh, you know, the insurance, as far as spending, but no, that's it. I think it's a big thing. I think people just should just in general practice what they preach, have skin in the game for anything that they're doing, and always just have themselves on the same side of the table as their clients.
Makes sense. Well, thank you. It was great and very informative as always.
Likewise,
All right, we'll chat soon.
have a great weekend.